latest article that is the good, bad, and ugly in REITs. Basically, we have used the return on invested capital to help identify for you which are the REITs not to have in your portfolio. Now, ladies and gentlemen, for those who have been attending our REITs classes for the last 32 years, you notice that we have told you that essentially avoiding and sidestepping the bad value traps is as good as finding good REITs, because if you are able to not have bad REITs in your portfolio, example, REITs that have lost you great value. For example, in our article, we highlighted Dasin Retail Trust. It is actually Dasin of its listing in Singapore. We have actually told GCP Global students to avoid it. Now, how are we able to do it? And that's what today's video is all about. And if you like it, ladies and gentlemen, do join us for our next week's class on 13 November. Just click here, and then we will guide you through the website. We have talked about the good, the bad, and the ugly in REITs. Okay, and then essentially we want you to avoid the value traps with return on invested capital. Now, ladies and gentlemen, for those of you all who belong to the value school of investment, you notice that the return on investment capital is a key metric that is in de-rigor in identifying good stocks as well as good REITs. Essentially, it is the operating income of a particular asset or a particular company divided by the capital employed, which is the capital, the equity structure, plus the loans that's taken up minus the cash. So year after year, you are able to establish whether the company is giving you a good rate of return for the equity and the capital that's employed, which in this case includes both the short-term loan and the long-term loan. Now, in Dasin's case, one of the reasons why we have told GCP Global students at the very onset of its IPO that you should not be invested in this is because way back in 2017, if you look at its first year of listing in 2016, this is their first record. If you calculate all these actual numbers, you see that the return on invested capital is only, wow, a very miserly 2.55%. Essentially what it's saying is that for the assets, for the 4 retail malls that Dasin Industrial Trust have, the return on invested capital that is actually derived from these assets is only 2.55%. Of course, you may be asking, how can they be giving you 9% dividend when the rest of the media was actually loving them because of this 9%? And we told people, look, it is because of the capital structure that they employ. And it is actually, if you look at the real operating performance of assets, only 2.5%. So it's not sustainable. Now, again, in 2018, when you thought that things could have improved, but things actually went down, which means that the return on invested capital for Dasin Industrial Trust actually went down to 1.9%. And then again, in our presentation at the SGX for Maybank Kim clients, where, as you know, SGX auditorium seats almost 200. We had a sellout crowd that day. We have won on Dasin then and there again. And then if you look at 2019, the same story continues, ladies and gentlemen. So instead of making acquisitions and enhancing the ROIC, the return on invested capital for Dasin continues to fall. That is down to as low as 1.65% in 2019. And of course, in last year's Money Matters, where we were interviewed for almost 2 hours with Money FM 89.3 together with the lovely Michelle Martin, we have stressed that actually Dasin Industrial Trust is one stock that we have avoided from the onset and continue to avoid for reasons that we have already explained earlier. And not surprisingly, ladies and gentlemen, you can see the huge fall in Dasin from the IPO price of 80 cents. It is trading at 38 cents now. This would have meant that you have lost close to $500,000 if you have put in $1 million in investing in the stock just at its IPO level. But more importantly is that Dasin went on an acquisition spree last year, and they actually went in to raise placement price 78 cents. And you know what, ladies and gentlemen? For every 1 million that you have invested in it, you notice that you would have lost close to $512,000 on the placement. And guess what? Placement are supposedly taken up by the smart money, isn't it? And how is it that the smart money, now Dasin raised 94 million at the placement, which means that the smart money would have lost $48 million in just a course of just 16 months. So, ladies and gentlemen, it really pays to be smart. Okay, so to be smart and sharp, that's what we teach our students for our REITs classes. If you like it, do join us for our 13 November class. We have extended the early bird special for just a further 1 week until next Friday. The course outline is given there and more details at GCP Global website. So stay well and make sure you avoid value traps in REITs, because that's how you grow your wealth. And do join us for our 13 November class.